the planning goes about like this. We have about cover 10 chapters, and that means 15 weeks, okay? This means 2 chapters are 3 weeks, then the second 2 chapters are 3 weeks, and then the next 2 chapters are 3 weeks, okay? So, chapters 1 to 4, we have budgeted roughly 6 weeks. Okay, this means that my plan is to have chapters 1 to 4 that I cover them. Now is week number 4, to cover them in 4 weeks, and then you have 2 weeks. Week 5 will be only exercises and solving problems here in class, okay? That will be chapter 3, and week 6 will be chapter 4. And hopefully, instead of taking 6 hours, we can take 5, so that we have a little extra, because the calculations in chapter 5 are difficult and nasty. But roughly, my plan is to complete by week 4, meaning this week, to complete chapter 4, and then devote next 2 weeks on calculations and problems, you know, for chapter 3 and chapter 4. And this is where your vacation ends. This week, the vacation ends, okay? Means next week begins real work, where you actually got to solve problems, and actually got to pay attention, where you actually have to have the textbook, and the rest of the problems you'll have to have as a homework. So we'll do as many as we can within 3 hours in the classroom, and the rest, maybe we do them, or you do them all, maybe not. So 3 hours we solve in class, and the rest has to be in a homework. And the same applies here. All right, is it fairly clear? So from next week, you'll actually need at least a textbook for the problems. Of course, you can take a picture and whatnot, but you'll need to have the chapters, the ratios, and so on. All right, so that's my little story. Let's get back on this side of the board and say chapter 4, financial statement analysis. Financial statement analysis is the easiest of all things in the world of finance, simply because when you graduate and get your degree in finance, when you get a job in the financial industry, the first job, the easiest job in the world is financial statement analysis. It is easiest because it follows straightforward steps. You do this ratio, that ratio, you look at this, and this, and that's how it's done. And that's what I'm supposed to do this week over the next 3 or so hours to cover this chapter. So, section 1, 4.1. So, page 92, 4.1. Why? Why do financial statement analysis? Number 1, you evaluate performance. We call it performance evaluation. Is management doing good? Is sales doing good? Is whoever doing good? So that's performance evaluation. Number 2, so let's write out. Performance evaluation. Number 2, if the business is doing very good, you're going to get big bonuses. or maybe not. So you do financial statement analysis to evaluate the performance of management for the purposes of bonuses. Number 3, financial projections. Now, projection, and I already did this a while ago, is exactly the same as forecast. Well, you want to know where you are going to be financially a year from now or 6 months from now. And forecast is also known as budget or budgeting. So, you want to do your budgeting. You want to know where you're going to be looking. And budgeting, you need to know to see if you may run out of cash and you may need to borrow. If you may need to borrow, you should know in advance, because a lot of times borrowing doesn't take a day. It may take a month. And the next one is basically for lending. You want to do financial statement analysis as a lender, lenders, okay, creditors will do that. So if you're a bank, they'll want you to do financial statement analysis on a particular business to find out if they are, we say in finance, good to borrow credit. How we call this? Good to borrow credit. Credit worthy. Credit worthy. Credit worthy. Are they a good credit or not? And then the last one will be investors. If you're an investor and you want to see, you want to buy the stock or don't want to buy the stock? Well, first question is, how are they doing financially, given or provided that they don't cheat on the account? And it's a completely different subject in accounting of how to cheat and how to catch them cheating, okay? And the common I've been already explaining is the subject, very modern on Wall Street, is called accounting forensics. The company was showing profits all the time, profits were growing, everything was good, everything was going great, and the company went bankrupt. And everybody says, what the hell happened? How did it happen? It's kind of like you get these business executives that eat all the junk and all the other stuff. They go, they run, they feel, they run the company, and just as they run the company, well, they just say, and they get a heart attack, and then they just fall and die. It's like, what happened? You know, he was good, he was looking good, he was doing good, and then he just died. Well, financial statement analysis is kind of like a medical exam into the financial health. You check the blood pressure, you check the heartbeat, you check the blood sugar. It's the same thing here. The blood pressure, the blood, you know, those things are, I gave you a little sheet. Now let's get back. Did all students get those things here? Okay? All right, well, I'm going to jump a little bit. Basically, what is the financial? Yeah, let's do that. Financial health. All right. Basically, if you have somebody going to a medical check, the first thing they're going to check is your pulse, right? Then they're going to check your blood pressure. They're going to check your weight, okay? They're going to check your blood sugar. What's the financial health? Number one, you're going to check, first and foremost, liquidity. Does the business have enough money, enough cash on hand? That's number one. Number two, it's a little different in the table, but again, that's how I'm thinking. So, first, do you have enough cash? Second one, do you make money? Is the business profitable? profitability. Let's see what else we got. Yeah, next one. Asset management. Asset management means the following. Do we use our assets efficiently? So, for example, we got our own body, somebody might be fairly skinny, you try to get them run for a kilometer. Can they run a kilometer in 3 minutes? Right? They may run for 100 meters. You know, it's the same thing with the inventory. You got an inventory, you got a phone shop. Are you able to sell all the phones in a month? You turn over your phones, meaning your inventory in a month, and then the next month you sell a second batch and a third batch. In other words, how many times you can use over and over your inventory in a year. If you can turn over fast, you're efficient. If you turn over slowly, you're inefficient. If you turn fast, you're running. If you turn slow, you're just walking. Okay? So asset management is important. We have a separate measure for the long-term assets. We call them the business investments or the capital expenditures, and have a separate measure for the inventory. All right, let's see what's next. Next is, oh yeah, capital structure. Capital structure, when we say capital, means the following. How the company or how the business is financed. Is it financed with debt or is it financed with equity? So here capital structure refers to debt or equity. If you are 10% in debt, you're in debt up to here. If you're in 50% debt, you're already debt up to here. If you're 80% debt, you're already up to here. Meaning you're barely breathing. Okay? If you're 90% in debt, you're in deep trouble. Okay? So it's kind of like your blood sugar is sky high. So capital structure tells you the level of indebtedness. A very nice, sweet way, but it's not a finance term, which we like to use, is called the debt burden. The debt burden. Debt burden is kind of like the fat in the body. Having 60 or 80% of the fat in the body is way too much. You're way too heavy. Okay, you're not flexible, not good. But 10 or 20% is considered healthy and normal. Yeah, you can raise fat up to 30% and function normally. So debt is a burden similar to fat, but not exactly. Okay? So that's the capital structure. Which is the last one? What's the last one? Number 5. Again?
Market value.
Oh, market value? We have it? Yeah, sure. Market value. Market value is what the market, financial market, thinks of you and your business. Is your stock high? Is your stock low? Is the market willing to pay a premium or a higher price? Now, you guys, when you're paging, this is page 95. Page 95. And on page 95, there is a little table, that's section 3. So that's 4.3, the beginning of 4.3. Do you see that little table over there? So basically, reading the liquidity ratios. I'm going back all over again, reading from the textbook. How liquid is the firm? Okay? Will it be able to pay its bills on time? That's liquidity. Capital structure ratios is how has the firm financed the purchases of its asset? Is it mostly borrow or is it mostly investor capital? In other words, is it deep in debt or shallow, not deep in debt? Next is, what is next one? Asset management. How efficient has the firm management been in utilizing assets? How efficiently you utilize assets. So this is about efficiency. In other words, a business may not have a lot of debt burden. We say the business is lean, but it may not be running fast anyway. Just because you're lean doesn't mean you're a good runner, okay? It's not necessary. You may have a guy who's a lot rounder and he can run a lot faster because running is not dependent on fat, it's dependent on your heart. Is your heart strong enough? On your breathing, are you able to breathe efficiently? And are your muscles holding well? So good running, good efficiency is depending how well you use your assets. And your assets will be your heart, your lungs, and possibly your muscles, your legs. So that's asset management. Profitability. Has the firm earned enough adequate returns? Now, on profitability, we have the concept of adequate return, which is kind of like normal. It's kind of the following. You got a little restaurant. Small restaurant's got only 4 tables, got only 4 employees, maybe 1 waitress, 1 cashier, 1 or 2 cooks. Okay, is it normal to make $500 profit a month? Or $1,000 profit a month? Or $5,000? What is a normal profitability? Well, you're going to look at it like this. Well, how much capital is invested? Let's say if it's invested, let's say $10,000, that's the whole capital thing. Well, on $10,000, is it normal to make $5,000 profit a year? In other words, is 50% normal, or 10% normal, or 5% normal? Or, I'm just saying, not personally to you, have your little hair salon, okay? And you got 3 hairstylists and they do hair, they do nail, they do whatever. It's called beauty shop, right? Well, inner salon's making only $700 a month. Is this enough or not enough? Is it adequate? Is it normal? Well, you're going to look at all of those things and it will tell you. Now, jumping to the very end of the chapter is the following. When you make financial statement analysis, you get clues. You get ideas. It gives you an idea what might be right and what might be wrong. Financial statement analysis does not provide answers, okay? It doesn't provide solutions. It gives you in health, medical, in car, it's called diagnosis. Diagnosis basically says what's right, what's wrong, okay, and what to look for. It basically, financial statement analysis is a starting point telling you, do you look this way, or do you look that way, or do you look lower or higher? Basically, it tells you where to look for and what possibly to dig further. So it's a starting point for further research. If you think it's going to give you answers or solutions, again, wrong. It doesn't do that. but it provides hints. That's another nice word. Hints. Hint. So, it gives you clues, ideas, hints. It gives you a diagnosis. It's kind of like somebody saying the following: I don't have a lot of energy, and I don't feel very good. Well, how's your head? I'm okay. You know, how's your heart? I'm okay. You know, kind of like everything appears okay, but the guy's not strong, not energetic, not, you know. It's kind of like then you start looking, well, let's see your blood pressure, let's see your vitamins, let's see, you know. You keep looking at 20 or 30 different things, and some of them might look better, some of them might look worse. Well, which are those things to look at? Well, these are the ratios. And these are the basic ratios. You have basically, I can go back now. You have liquidity ratios, how many? How many? Number. What's the number? You got 5 liquidity ratios here. You got capital structure are 2 ratios. Asset management efficiency ratio, where's the efficiency? 3, or 2, is it 2? 2. Then profitability is like 5 of them, 2, 4, 5. And market value ratios will be 2. So now immediately you see, here's just me, I wasn't even looking at the textbook, is how I gave you liquidity. You have 5. It's kind of like tells you it's relatively more important. And then it's not a chance that I gave you second profitability. Profitability, of course, is the second most important. And I got 5 indicators about it. And these 3 here are extra clues. So, if I'm not mistaken, you get roughly about 16 of them. For this particular course, you don't have to memorize them, and you can use this sheet for the quiz and probably for the midterm. You can just bring this sheet for the quiz. So, what's next? Next piece is very straightforward. It gives you clues and ideas. The most important thing is the interpretation. Interpretation basically means what is the meaning of the ratio? What is the ratio telling me? That's the interpretation. What is it good for? What it tells me, like a blood sugar. What does it tell me? Like a blood pressure. What does it tell me? Like heart rate or heartbeat. What does it tell me? Okay. Like overweight. So, what does it tell me? That's number 1. And number 2, oh, you got 17% body fat. Too much or too little? Too much or too little? Well, what's normal? Too much, too little, normal? Okay. Normal is called in finance, let's introduce a brand new term. It's called a benchmark. Benchmark. Benchmark is the normal standard value that you compare against. In medicine, they say that normal heartbeat is 72 beats per minute. But if you're well trained and healthy, 60 will be even better, okay? And for some top athletes, they could have a heart pulse or beat of 50, okay? So, benchmark will be between 50 and 70, where 70 is perfectly normal, but 60 or 50 is better, okay? Well, what about the blood pressure? 110 by 70 is just fine, okay? 120 is still okay. 105 is very good on the top. We call it systolic, okay? And if your blood pressure, but there's something else. Blood pressure for women could be lower. 160 is fine. Having 10 units lower blood pressure for women is perfectly normal and perfectly healthy and very common, okay? So, you need the benchmark, and that's what, you need to understand here in finance. What are the benchmarks, okay? Well, the benchmark is commonly the industry. Of course, industry banking will have one types of ratios, profitabilities, and benchmarks. The automotive industry will have different. The restaurant industry will have a... So every little industry will have different benchmarks. Kind of like blood pressure and pulse for a 2-year-old baby is going to be very different from a 12-year-old child. Very different from an 82-year-old man. So benchmarks will change according to your age. They'll change according to your sex. They'll change according to your overall fitness and condition. Same thing is here, according to the industry. Is the industry young and growing, or the industry is mature, or the industry is oversaturated? Okay? The example of saturated industry in the West will be the car industry. Just got cars everywhere. They're cheap. Car business is highly competitive. So it depends on the industry, and it's an actually consequence of industry is the competitiveness, which is important. All right, let's see what else I got here. Well, I can jump back to section number 2, which is 4.2, the types of analysis. Okay, what types of analysis? One is called, so this one is common size statements. Okay, well, just types. The first big one is called common size. Common size. Common size statements. In a common size statement, you convert everything to percentages. Okay? So, in a balance sheet, all right, that's not BS. It's balance sheet, okay? In a BS, you will divide by total assets. So, you get the balance sheet, you divide by total assets. Total assets will equal 1, meaning 100%, and every other number will give you percentage. So, cash will be 3%. 3%, good or bad? The answer, depending on the benchmark. Okay? Well, inventory is 12%. Oh, good or bad? Again, depending on the industry, what the benchmark is. For some industry, 5% inventory is extremely low. For other businesses, it's extremely high. Okay? Depending on the type and the nature of the industry. Is the industry associated with a lot of, for example, service industry has few inventories. Service industry, dentist doesn't have a lot of inventory, okay? He may have a lot of equipment, but very little inventory. Okay? This university has very little inventory, not because it's bad. The nature of all universities, yeah, we got a few markers, we got a few paper, but overall the inventory of the university is very low. It's the nature of the business, and it's the nature of services to have relatively few inventory. So you need to compare the benchmark, you get it in percentages. And for the income statement, you divide by net income. Or sales. Let me take a look, because there are two ways. You can usually divide by sales and get everything as a percentage of sales, or get everything as a percentage of... Alright guys, anyone can take a look? What's the common size income statement? Common size income statement, they tell me at the very top. Page 63, page 90. 3 table is 1. And you see that in table 1, sales is normalized to 100%. So you divide by sales, which is the same as, I'll write it out, revenue. And you compare everything to revenue. So you calculate your returns, everything, you calculate your gross profits, and they tell you they're 25%. Oh, gross profit is 25%, okay? So when you do divide by revenues, you will get the different, what we called, and I was, must be last time, margins. The gross margin, the net margin, all sorts of margins, right? You get the margins. The margin was usually in percentage terms. Tell this guy, enough with this phone. I see you've been playing. I mean, I understand it's fun, right? Next time, if you're playing, I'll give you absence, okay? All right, so that's the margin. Let's see what else I got. So, I did number 1, number 2, common size income statement, common size balance sheet. I don't remember where it's at the next one. This is the common size statements. The second type of analysis, maybe it's coming in a later section, is called trend analysis. And trend analysis, basically, you look at profit. And from period to period to period. Profit, 1.1, 1.3, 0.9, 0.7, 0.5. Is there a trend? There appears to be. And if this is revenue, it doesn't look good. You know, for the last 4 years, revenues are going down, okay? So you just look at what happened over the last 3 years, or over the last 5 years, or over the last 10 years. You look at profits, what happened over the last 10 years. You look at cash, what happened over the last 10 years. You look at sales or revenues, what happened over the last 10 years. And you judge. Sometimes all you need is a graph. You don't need a sophisticated statistical analysis. Oh, that's the nice thing. You don't need fancy software in SPSS. All we take is a look, right? It's basically when you see the chart, it's like looking at the person and say, oh, looks nice and beautiful, or doesn't look nice. Meaning, you just take a look. You don't need statistical software to analyze the different features. That's trend analysis, okay? Now, it may be that some trends will be in the opposite direction. Like in Wall Street, revenues are going down, and profits are going up, and up. Something's wrong here. Meaning, you can't grow profits by shrinking revenue. Yes, if you're shrinking revenue, this means that you're shrinking your expenses even faster, but this is not sustainable. So these guys are cooking the books, they're lying, they're cheating, it's accounting fraud, or they're just rapidly cutting costs, which if you keep cutting steady year after year after year, you cut a lot of costs. This means that your economic growth will not be good. In other words, you may be cutting costs, you may be cutting investments, and you may increase your profitability, but the trend is not sustainable. And that's what's been going on over the last 5 or 6 or 7 years on Wall Street. And I'm going to get back to the maybe 2 lectures down the road. For example, that earnings per share. How much money or profit you get per share? Well, they play little accounting games. They borrow money, debt. They buy their own shares. We call these stock buybacks. The number of shares shrink and earnings per share increase. And in accounting terms or in financial terms, things look good. But just because they look good doesn't mean that they're good. It means that they used accounting and financial games. And that's what financial statement analysis is. It gives you clues what might be the game that they're playing, how they might be manipulating things. In other words, a financial executive will, an accounting executive, of course, when they were second-year students, they did these ratios. They know that financial analysts will use these ratios. So their goal is to make these ratios look better than they really are. That's the difference between an accountant and a good accountant. A good accountant makes things look better than they really are and still keep it legal. Okay, that's what accounting is about. Let me see what I have. So we finished for today. I did the column, I did the different stuff. Okay. All right. Well, next time it is going to be only ratios. We're just going to go through these whatever 16 ratios and one by one, step by step. Spend about 5 minutes on each. Explain each, and that's it. All right. Thanks.